Welcome to another edition of Your Long Range Plan. My name is John Kennan, and as always, sitting right next to me is Paul Tierney. We are both elder law attorneys with a specialty, more or less, in all phases of elder law planning, wills, trusts, estates, estate administration, and so forth. And today we have JP, John Paul Sweezey, long-term care specialist here living on the Cape. And I'm going to let him introduce himself for a bit. Just give us a little bio.
Well, hi. I've offered long-term care coverage for almost a quarter of a century here on the Cape. I broker every company, and this is all I've done. Although I have other licenses, this is the only arrow in my quiver.
Well, I'll ask the first question. What is long-term care insurance, or what is long-term care coverage?
Well, the coverage known as long-term care insurance has existed since the early 70s. And there used to be quite a few different carriers. Now it's down to maybe half a dozen that are in the mainstream. And basically long-term care is when one needs assistance at home or in a facility with any of their activities of daily living, or they're suffering from some type of cognitive impairment. And the coverage basically reimburses one for expenses incurred once you meet what's known as a triggering mechanism, which is pretty much standardized in the industry.
Yeah, JP, what are those triggering mechanisms? You talk about these activities of daily living. What are some of the activities of daily living?
Well, it's very simple. There are 6 primary activities of daily living known as ADLs, and those are bathing, dressing, toileting, continence, feeding, and mobility, or transferring from, say, chair to bed. And the triggering mechanism is one must need help with any two on a sustained basis in order to have the benefits kick in, or your doctor must say that you need assistance because of cognitive impairment, and that would be Alzheimer's, senility, dementia, or depression.
Now, if that happened with cognitive impairment, do you still need to be able to need 2 activities of daily living to have this trigger in, or is it just a doctor's opinion that somebody's cognitively impaired?
No, the cognitive trigger can be alone a single trigger. Most of the time, it's both. You know, it's pretty interesting, having done this for so long and experienced a claim in my own family. But with science and medicine keeping us alive longer and longer, it's nearly a certainty that you're going to live a long life. And when you do, you get old. And when you get old, you need some type of care because you're either sick, frail, or forgetful. Or in my father's case, a combination of all 3. And when this happens, we need care, and when we need care, somebody has to give the care, somebody has to pay for the care, and somebody has to coordinate, line up, and supervise the care. This is where the concept of the burden comes in, burdening one's spouse, children, etc. So the coverage dramatically eases, sometimes eliminates that burden.
Now, JP, so say our elder loved one, we think that, you know, they maybe need some help or some assistance. How do we figure out if they're going to trigger the policy? I mean, is it just typically their doctor that would be making these decisions, or are there other types of individuals, geriatric care managers? Do the insurance companies send people out? What's the process if we feel that, you know what, mom or dad or aunt, uncle really seems to be, you know, slowing down and may need some help? What's the next step if that's that seems to be the case?
That's a great question, and it's a combination of all 3. When you suspect somebody is possibly ready to claim, you call the insurance company. You also let their primary care physician come into the picture. And the insurance company usually will send in an independent person to assess the situation, usually a nurse of that, someone of that caliber, to determine one's eligibility. Today, the triggering mechanism has been standardized, so as long as a doctor, yours or somebody else, says you meet that trigger, then you're basically satisfying the claim.
Okay, so you'd put a call into the company, you know, as well as dealing with your physician or the family's physician, as you normally would if you know, you suspect that you know, the elder needs some help or needs some assistance.
And another smart thing to do is contact the agent. I give my home phone number, which I sometimes regret. But no, I like to be reachable, and people call me and say, gee, this is what's going on with Mom. What do you think? So that's kind of why it's important when you deal with this type of coverage to have somebody who specializes in long-term care coverage, which is why many independent insurance agencies don't necessarily deal with this. They often refer to someone like myself.
So this is care not generally covered by your typical health care, Medicare, Medicaid. This is within its own realm, if you will.
That's a great question, because there's always been confusion about what's covered by regular insurance and Medicare and supplements. Medicare and one supplement covers pretty good coverage for the first 90 days, as long as somebody was hospitalized 3 overnights first. Then they pretty much drop the ball when it comes to somebody in a nursing home, which is why in designing this coverage, it'll have a 90-day elimination period, or a number of days it won't cover in the nursing home, because that's often covered by one's health insurance or Medicare and supplement. The problem with what is going on out there is that home care is rarely covered for any length of time by Medicare, supplements, or regular health insurance. You get part-time, intermittent, and only skilled type care at home. And what long-term care usually requires is custodial assistance, one's activities of daily living, someone to go shop, someone to prepare meals, do laundry. That's what this coverage covers. It isn't just lift and bathe and dress and feed you. The better plans today will pay for someone to go shopping, make meals, really a companion, chore worker. And an interesting quick note before I forget it. The average age of applicant has come down to age 56.
I was going to ask,
I'm
is it
56.
Is it age determinative?
Well, that's what the average is. I used to sit with people when I started this over 20 years ago, 71 was the average. Today it's 56. So you're probably not too young to consider this. And when you get coverage, the premiums, similar to a term life policy, remain constant. So it's far cheaper when you're in your 40s as opposed to waiting till you're 75, because the company expects to get that many more years of premium.
Right.
So, and the only other thing, 75% of long-term care insurance claims are totally satisfied at home. If they've got this coverage and it's designed within the past decade, most of the time they never get to the nursing home. If they do, it's for a very brief stay. So when I call this nursing home avoidance coverage, I can mean it. Because if you've got a relatively robust policy, you may never have to leave home. That's kind of nice.
Now, JP, say the policy does kick in, somebody's at home, and they don't have any real people lined up. I mean, what's the next step? Would some of these policies actually find people, or can you have your own people? What about family members? Would they, would the coverage cover family members in that role, or do you have to be like a certified home health aide or meet other criteria like that?
That's a great two-part question. The first part is that most of the companies will assist in finding someone. There are a couple of, the top couple carriers will actually locate, install, and supervise the care. So one's child could be involved with your care in a voluntary, more supervisory role. And in terms of one's immediate family member, most of these companies don't want an immediate family member to be paid to live there to take care of someone. You know, there are ways you can kind of get around the system if it's maybe a cousin or somebody's last name changed. But to tell you the truth, most people don't want their kids having to lift and bathe and feed them. They'd like somebody more experienced or somebody other than a child to do that. This basically reimburses one 100% of expenses incurred up to a dollar limit that you set in designing the coverage. This will pay so much a day, so much a month, so much a year, for so many days, so many months, and so many years. So an example would be a 4-year plan, which is a very popular plan, is good the rest of one's life. The 4 years don't start ticking until you start claiming. And the majority of the claims are at home, and quite often home care may be every other day for quite some time. So if it was like that for a while, a 4-year plan could go 8 years of constant use before you've run out of money. And if the plan would pay, say, $200 a day and you only use $100, the other $100 rolls forward and stays in your pool of money. Your plan's good the rest of your life until you've spent all the money in the pool. These insurance companies expect when they give you a policy, you're going to claim. They just hope not for very long. And most of the time, they win. You don't use all the money in the pool. And you know, you really want them to win once in a while, so they stay solvent.
Yeah, my understanding is one of the issues now with a lot of long-term care insurance companies, or insurance companies in general, had gotten into this coverage area and have decided, for whatever reason, that they weren't going to stick with it and have ceased covering long-term care claims and having, you know, future policies being issued. So I think we're really seeing a specialization with just certain few companies now that are out there as compared to there were many more in the past.
Great point. Two of the primary carriers that have offered this have pulled out of the industry in the past year. And it's too bad because now you can't get them anymore. But the people who've had those policies are still covered. It's a contract. It's backed by a state bond system. You know, it's similar to FDIC in a savings bank, but it's not federally done. It's done by state, which is why it's important that the state you're in, the policy you get, is state approved.
Yeah, I remember hearing even years ago that if people were interested in long-term care insurance, you wanted to make sure that they had and purchased an individual policy, which I know has a different connotation than a group policy because of the fact that the individual policy, if that was going to be supported and allowed to be sold in, say, Massachusetts, it had to meet pretty rigorous criteria as a policy. It had to have cover, you know, certain, you know, dementia. It had to cover, you know, the things that you'd want it to cover. Whereas some of the other policies, if it was sold as a group policy, could kind of pick and choose what they wanted to cover. And all of a sudden, you know, you thought you had coverage, you know, hey, long-term care covers me for anything that I would really need. You kind of find out that, hey, wait a minute, no, it only covers, you know, long-term care if you got it on a Tuesday. You know, I'm exaggerating, but
no, but
good point.
But,
relevant.
But if it was an individual policy in Massachusetts, that meant it was pretty rock solid because of the criteria it had to meet to be issued that way.
Yeah, I was going to ask the various types of policies. Actually, I had a series of questions, one of which I asked you, two of which I asked you, and follow-up were benefits. if you could talk about benefits and then the various types of policies, not necessarily in that order.
Do you mean
just,
policy design?
Yeah, all of that. And
all right.
touch on a little bit of what Paul was saying, if you could elaborate.
I'll comment on the group individual point. That was far more important prior to federal regulation of these policies, the beginning of this century. Sounds like a long time ago, doesn't it? But yes, now a group policy must meet state regulation in most areas. So that differentiation that you speak of isn't as big an issue as it was. Before, with some of the older policies, if you had a group plan and then for some reason we're having a challenge with the company, the state couldn't come to your assistance. Now, the Division of Insurance will come to your aid. So it isn't as big an issue as before. The reason group coverage exists versus individual is really more or less to expedite entry into the arena. If you meet numerous states' regulations in a group format, then you come to market faster. If you have to go to each state one by one and get through their red tape, it's a far more tedious, often a year or two process. So that's why that was avoided before. It isn't like these companies were trying to do something wrong, although some have in the past, but that's the real reason, to come to market faster. To address your point, in designing coverage, is that what you'd like me to comment? You basically choose how much this will reimburse you. Most folks don't have us cover the whole table. You co-insure this risk and cover half to 2/3 of the risk, and that risk being the catastrophic nursing home. So if they're averaging $330 a day today in the Cape, which is accurate, $10,000 a month, then the policies I design are usually $5,000 or $6,000 or $7,000 a month reimbursement, because people have enough income to co-insure they stay in a nursing home if they had to.
And plus, that would be like the catastrophic situation, and like you said earlier, a lot of times people aren't maybe ending up in a nursing home if they have this type of long-term care coverage, and if they can be cared for at home. I mean, great. That's what most people want anyway.
And that's where the $5,000 or $6,000 per month indemnity is sufficient. And then the next choice is in an elimination period, and the standard out there is a 90-day elimination period or wait deductible in a facility. What's really important, and what many carriers don't provide, is a 0-day wait at home. That's very important when you're choosing a carrier and designing a policy. You don't want a waiting period for the home care. Many policies I review, many of which I replace, the elimination period in the nursing home applies to the home care too. And you don't want that because it's a number of days of service. And if you're getting help every other day at home and you have 90 days of service out of pocket, that could be an entire school calendar year before the plan would kick in. And that isn't good, because quite often somebody has a medical event, they become dependent, and often at the end of 3 or 4 months they've either improved and don't need the care anymore, or they've deteriorated and need a hospital or a nursing home. So one of the loopholes in some of the policies that exist out there today is that people don't understand that the elimination period should be 0 for home care.
Oh, that's very interesting. I never knew that.
And another quick point is just about every carrier, except one, requires your home care come through an agency or you use licensed or certified help, which really isn't fair, because if all you need is someone to go shop, make supper, do the laundry, change the beds, why do they have to have a little hat and a name tag on? You don't need that level of training if that's all you need. And you can get the help far less cost per hour if you can choose somebody yourself without having to have the agency as a middleman. And you may have a friend or a neighbor that you like and trust, and you'd like to have them be the one caring for you.
But what you're saying is you can't go that route? most of the carriers are mandating that you have a specialist?
Yes. I don't know if you want me to specify carriers or not, but I can be carrier specific if you'd like.
So most of them do require that? And
All of them except one
Okay.
require agency certified home health aides, which is 2 to 3 times the cost.
Yep. What is the cost of a home health aide these days?
Okay, many agencies are $40, $50 per hour, whereas the people who work for the agency are getting $10, $11, $12, $15 an hour if they're lucky.
Now, if you're having a policy that has been activated, can you choose these people directly, or do you have to go through an agency?
Well, again, if you've got the right carrier and you chose the right agent, then you don't have to. You can pick whoever you want and pay them whatever you want. And this reimburses you for expenses incurred. You simply send in receipts, bills, whatever.
Now, JP, a lot of times, you know, we have these workshops where we're trying to educate people about estate planning, and I always recommend that people check out long-term care insurance, see what it would cost them. Yeah, obviously we don't want people staying in Saturday nights just to be able to support the premiums. But what would you recommend? Say a typical a couple in their like late 50s came to see you. What would you typically recommend for coverage, for term of coverage, for daily benefit?
Okay.
And what would that cost, you know, again, roughly? I know you'd have to do medicals when people are applying, so it depends on their physical condition as well as their age. But say you had somebody who was relatively healthy, couple say 58 years of age, or 62 years of age, just over their 60s. I see a lot of people, that seems to be the age where they really start to...
60 seems to be the magic number.
Yeah, yeah.
I'll comment on that.
What would you recommend, first of all, for a range of coverage, and what would that typically cost?
Let's give some ballpark figures, because I think that's what our viewers would like, and quite often that's danced around. I'd like to, because most of the time I design coverage, people say, wow, that's less than we expected. What a nice thing. So here we go. Ballpark figures. A 50-year-old couple can get by with $200 to $300 a month for both of them for a very robust policy, and I will explain what's in that policy. My average 60-year-old couple will spend right around $4,000 a year. 65 will be probably closer to $400 a month, and 70-year-old will be closer to probably $5,000 to $6,000 a year.
Now, is that a couple, or is that a single person?
A couple.
That's a
So
couple.
it seems like three to $500 a month, roughly.
There's a real safe ballpark
Right.
for a couple.
For a couple, $300 to $500 a month,
And his-
depending on the age, 50, 60, 70.
Right.
Yeah.
And one more quick thing. In Massachusetts, if you spend down in a nursing home, the state can put a Medicaid lien on your home. Could actually force the sale of the home. There's a tremendous incentive many people aren't aware of. If you've got long-term care coverage and you don't need much, and you go to a facility and spend through that policy and don't have a whole lot of assets remaining, then you can gracefully go on to state aid, Mass Health, and your home is exempt as a tangible asset.
We talked about that earlier.
Yeah, and what's the minimum coverage? I mean, I believe it used to be, if you had a long-term care policy for, what was it, $125?
It is.
Per day for a 2-year period of time?
Right.
If you had that in place and then went on Mass Health, then Mass Health will not file a lien on the house.
That's exactly right, Paul. And a 2-year plan, $125 a day is the state requirement. That's all you need. That could be $50 a month cost for one person. It could be $100 a month cost for somebody, say, 60, 65. So if your goal is to protect the house exclusively, which quite often it isn't, but you can get by with very little of this coverage. 99 out of 100 people choose more coverage because they realize that's not really enough. In fact, that minimum, we've heard, is going up over the next probably year, year and a half, 2 years, to closer to $175 a day.
Well, what I'd like to also point out too is with a lot of these coverages and we're talking about, you know, protecting the home if somebody just wanted to get a minimum plan, for that to work and have Mass Health not lien the home, they have to have that coverage in place when they go into the nursing home. Okay, so if they've already started using that coverage for home health care and all of a sudden they've been doing that for a year and a half or a year, and then you just have to take a look at the policy. Does it still have coverage, you know, in a nursing home for another 2 years at $125 a day? If it doesn't, because you've used some of that up, then you're not going to meet the minimum requirement. So a little bit of a technicality, but I think it's important to, and again, if I'm recommending a client to purchase long-term care insurance, and that's one of the criteria that they want to get in as cheaply as they can, then you don't want to necessarily skim on the coverage. You want to beef up that coverage a little bit, so if somebody did have to have home health care and eat into the policy before they went into a nursing home, you want them to have at least that minimum coverage left in the policy when they went into the nursing home.
Great point. That's why the majority of people that know what they're doing do not offer a 2-year plan. The least we offer is a 3-year plan. That way there's 365 at least times of home care before that would touch that. To answer your point about designing a policy, I'll just make a quick statement. The most popular plan I sell today is an 8-year shared plan. So in other words, instead of each having a cup of coffee, there's a pot of coffee. So one could use it 1 year, 1, 7, 2, 6, 3, 5, any combination thereof. So one can share
a couple's
policy.
Need dependent. That's pretty good.
Right. And when one goes on claim, both premiums cease. And if they've had the policy for a decade and nobody has claimed, should someone pass on anytime after the 10th premium payment and hadn't claimed, the spouse gets both policies free, paid up, no more premiums due.
Wow.
So there are some dramatically enhanced programs out there that many people are not aware of. This coverage really deserves a second look if you've considered it before, because, you know, sometimes somebody will say, well, gee, we've got plenty of money, we don't need this, we can self-insure. Well, if that's the approach, then cancel the fire insurance, cancel the collision, because you've got plenty of money. You'd never do that. You need to realize, out of all the things you've bothered to insure in this life, this is the one you'll most likely collect on. So that being a given, then the wealthier people necessarily don't need this for the money it gives them, although that's nice, but they choose this because of the burden factor. No matter how much money you've got, you don't want to be a burden to your loved one, to your child. People don't buy this coverage unless they love their families.
I think I'd love to end on that note. We've just about run out of time, and you were very succinct in your presentation about, you know, what you provide to individuals and couples, and how as attorneys we can work with someone like yourself in terms of I would say a sound or correct estate planning, you know, avenue. You mentioned earlier that it's not necessarily, or your implication was that this is great for everyone to consider. What it triggers is the next question for someone like Paul and I, you know, to assess our clients' needs, because this is purely educational, this program, and this is educating me, and I think you said too, you learned something, you know, on the 90-day to zero, you know. And I think we need to continue this conversation. We just can't do it now. We've run out of time, but I'd love to have you back if Paul would agree with that.
Sure, yeah.
So with that, thanks for tuning in. Thanks, John Paul. Thanks, Paul.
You're welcome.
And as always, we would love you to look at the credits at the end of the program. Call us, email us. If there are any questions that you have for either one of us, just shoot them our way, and we'll get right back to you in a timely fashion. Thanks so much, and see you next time.
Thank you.